Okay, hi guys. Thank you all very much for tuning into my weekly webinar with FX Street. Thank you, administrator. Thank you guys for your time today. I hope you've had a good week. It's been an interesting few days in the market with the weakening that we're seeing on the pound, so lots of profit to be made. If you're new to my webinars, guys, if you don't mind just giving me a little hello. If it's the first time that you're seeing me, regular guys, if you could give me a little hello as well in the chat box, just so that I know there's people out there. Online at the moment is just one person apart from myself, so I don't know whether that's members, non-members. I don't really get a general feel for this. So okay, if you're well, let's go straight into the analysis. Now, just a brief background of myself. I'm a long-term trend trader, so my trading style is very much dependent on what the market is suggesting, and I think that's crucial, because where a lot of people go wrong is they try to adapt the market to their personality, when in fact what traders should be doing is looking at the market and then adapting to the market, as opposed to trying to adapt the market to themselves. It's a very difficult and pretty much an impossible approach. Whereas if you know what kind of market conditions you're in, you can then apply the right strategy. So if we're in strong trends, you can use a trend trading strategy. If we're trading within an environment where long-term trends aren't apparent, then we want to look at a shorter term strategy. So it's good to be flexible rather than always just focusing on day trading and short-term trading. It's not the way forward. Okay, so the key really, and the key to trading is making money through holding positions and allowing your positions to run. We've all heard the expression, the trend is your friend, and that is the direction that you want to be going in. And it's not very well practiced. I mean, it's often heard, people understand the term, the trend is your friend, but it's not actually practiced very well. And that's why people tend to blow accounts and not get the returns that they're looking for. Okay, so that's a bit about myself, guys. Okay, I'm always looking to trade in the direction of the long-term trend. If you want to take things further after today's training webinar, then please check out the following website, www.tdtpro.trade. This is a month of training where you will get access to strategies, community support, software, watch list, a training in foreign exchange and stocks as well, guys. It's really, really important. Most people just trade FX, but it's not the way forward. If you think of Warren Buffett, stock trader, stock investor. So you want to be looking at stocks as part of your portfolio. You don't want to just be focusing on FX. So you get training in FX and stocks, and all of that is £99 for the month, or £99 plus VAT if you are inside the UK. All right, so let's go into the actual analysis itself, and I'm looking at the pound dollar here. What you can see is a typical chart setup of mine. So I've got my watch list on the left hand side. You can see it's quite an extensive watch list. Aussie dollar, US dollar at the top, all the way down to the South African rand, Japanese yen. So a very extensive watch list. Monthly chart in the top right, weekly chart in the bottom left, and the daily chart in the bottom right hand corner. Now, the reason why I look at multiple time frames is to be able to engage in overall what price is doing. In looking at just one time frame is not the way forward. You want to look at multiple time frames, and in addition to that, you want to look at the larger time frames, because the lower down you go, the more candlesticks, the more noise you have to deal with, the harder it is to see consistency and growth. So you really do want to focus on the bigger picture. Excuse me. Now, the monthly time frame is where I look for support and resistance. So the first indicators I'm going to load up are these pink lines. The pink lines represent the high and the low of the previous calendar year. So that's the highest price of 2015 and the lowest price of 2015. Now, these are essential. Why? Because not only do they act as support and resistance, but they also start helping us to create a bias in price. Remember, there's no guarantees in trading. Trading is all about probability. Understanding high probability environments where you trade and low probability environments where you stand aside. This is the key to trading. Now, I use these annual levels to help start developing the bias, developing these odds in my favor. So what I want to see is price trading outside of these pink lines. So if current price action is trading above the high we have a bullish bias. If price is trading below the low, we have a bearish bias. If price is trading inside these pink lines, we stand aside. So let's have a look at the euro dollar. The euro dollar, we can see that the euro dollar is trading inside the pink lines. This is very much an area of consolidation. You can see that price is just going sideways. Remember, again, this is the monthly time frame. So you can see how long price consolidates for. This is the last time I traded the euro dollar, when we were short for many months. Very good profits. I extracted over 15,000 pips on this trend to the downside. Since then, I've been standing aside because it's consolidating. However, if you compare that to the euro pound, we can see that the euro pound has, EURGBP A0-FX. Okay, if we look at the euro pound, we can see the euro pound has a bullish bias because it's trading above the high, and the euro pound is handing out good profit in a bull trend. And if we go back to the pound, you can see that the pound dollar has a bearish bias and is handing out good profit to the downside. Okay, so the annual levels, that's the high, the low of the previous calendar year. As we're in 2016, this is the high and this is the low, and this is the closing price of 2015. Okay, the next point I want to bring up are major pivot points. So I have a tool that highlights major pivots. These are strong levels of support and resistance. So we can see that current price action is trading below all of these levels. So all of these levels are now acting as resistance, and we are seeing weakness to the downside. Okay, so that's the monthly chart. The weekly chart is where I use the 200 moving average and the 50 moving average. And on the daily chart, let me just readjust that. Bear with me 1 second. There we go. The daily chart is also where I use the 200 and the 50 moving average. So what I want to be seeing is price trading below both moving averages on the weekly and below both moving averages on the daily in a strong bear market. So let's put the monthly, the weekly, and the daily together. On the monthly, I want to see price trading below the pink lines for a bearish bias, and I want to see price trading below the major pivots, so they're all acting as resistance levels as they are in this case. I want to see price trading below the 200 moving averages, which is the black line, on the weekly and the daily, and I want to see price trading below the 50 moving averages. So we can see that the pound dollar is doing just that, and it's suggesting further weakness, and short positions is what we should be looking for. If we go to the euro pound, we can see how the euro pound has the complete opposite setup. So we're above the pink lines, so price has a bullish bias. You can see how price is contending with this resistance level here. We had that flash crash on Thursday, I believe it was, and that's where this wick has come from. And you can see that price is contending with the round number 0.90 and this level here acting as resistance. If it breaks through these levels, then we should see further strength towards this resistance and the figure 1. You can see that price is trading above the weekly 200, above the 50, above the daily 200, above the 50. So the euro pound is one that, if you are long on, you should be remaining long on, and you should also be looking to add positions. This is where you should be compounding, and this is how you achieve growth in trading. Where a lot of people go wrong is they want to risk large on small moves and make money very quickly. Now, this can work in the right conditions, but remember, leverage also works against you. So if you're over risking and you don't have well-placed stop losses, you're going to start getting into big losses and eventually getting margin called and blowing accounts. So it's better to risk small, so you control your losses and you keep them capped, but allow your winning trades to run, and then compound to accelerate whenever you're in a trending market. This is the key. This is what all the best traders have done. This is what all the best investors have done, using fundamentals, if you like. But Warren Buffett, he's compounded. That's how he's achieved $80 billion worth of growth over his lifetime as an investor. Okay, before Warren Buffett turned 50, just before he turned 50, Warren Buffett had $50 million. Sorry, Warren Buffett had $300 million just before he turned 50. 30 years later, he's worth $80 billion. To go from 300 million to 80 billion is a staggering growth, and that can only be achieved through holding positions and compounding. You're not going to achieve those positions by being in and out of market on short moves and day trading and scalping, which is what you are encouraged to do. It's a very, very low success rate in that. And that is exactly how most people blow accounts. Let me just go make sure there's no question. Okay, hi guys. Okay, brilliant. Okay, fantastic. Thank you for the hellos, guys. It makes me feel comfortable that I'm talking to someone, because obviously I'm going through a computer and I can't see who's out there. So, thank you for the hellos. Um, going back to what I was saying, try and think long term, guys. As private traders, we have to be very particular and very selective and a lot smarter with the way we trade and approach the markets than uh, say if you're an institutional trader. If you're an institutional trader, you have millions and billions available to you. It's a different approach. Institutions use machines to trade for them on very small moves. But again, think of the funds they have available to them. As private traders, we don't have those funds. You could even have 100,000, 200,000. It's still not the millions and the billions that institutions have. So you got to think differently. In fact, if you think about it, we are at a huge advantage as private traders. We are at a huge advantage. Why? Because we don't have rules and regulations that we have to follow. We're in a completely lawless environment, but this is where a lot of private traders get stung, because ultimately they can go into the market, they can do what they want to do, over leverage, over risk, not use stop losses, trade whichever instrument they want, trade NFP. You can do whatever you want. And that is where a lot of private traders go wrong. Focus on protecting your money, focus on the downside, and allow the profits to take care of themselves. If you do that consistently, you'd be surprised with how quickly you can grow an account to very significant sizes. I started off with one trading account back in 2007 when I started trading. I now have multiple trading accounts. So I've split my money across different brokers, across different accounts. I have some for foreign exchange, I have some for stocks, I have some for commodities. Okay, and this is how you got to think of it as a business. Okay, so euro pound, guys, if you're not in this, if you go to the daily chart, you can see how since price broke above the 50, it's been going sideways, and now we've had this run to the upside. We've had a bit of a correction so far today. This is part and parcel of trading. This is not the end of a trend. This is simply price coming to retest the round number 0.90. This is classic price action movement. We want to see these things. If we don't see these things, if price just shoots through, then there's a very good chance it's going to fire back down again. But if we get this retest early, this is confidence. This is confident. This gives us confidence of a solid foundation for the next run up. Think of it as the roots of a tree. If we get a good retest of a support or resistance level, that's a good root that price has created for itself, and price can then go on to trend better. Okay, so get away from thinking instant gratification. Allow a trend to do what it does naturally. A trend is a function of time. If you eliminate time, you eliminate the trend. And if you eliminate the trend, you eliminate the profit. And this is what we're about. We're about profit. Get away from thinking in terms of winning and losing. This is not a game. This is not a battle. This is not about defeating the market. This is not a war. If you go to war with the market, you will lose. Okay, the market is too vast for you to even think about taking on. So it's better to align yourself with the market. Understand how the market moves, understand her features, understand the natural elements to price. If you embrace these, the market tells you what to do. The market will tell you what strategy to use, where to place your stop loss. The market will tell you, hey, be patient. I've still got more profit to give you. The market tells you many things if you learn to align yourself with it. But all too often, you get all of these guys, these so-called experts telling you, hey, just extract 20 pips. Hey, you only need 5 minutes in the morning before you go to work. Make 20 pips. Do the same thing the next day. How many people are successful doing that? We know for pretty much a fact that 90 to 95% of traders blow their trading accounts. There's also the 90-90-90 rule. 90% of traders blow 90% of their account in 90 days. Okay, these are certain facts of the market. So you have to look at that 90% and think, right, what are they doing? I need to do the opposite. So ultimately, where they're buying, you should be selling. And where they're selling, you should be buying. So the euro pound here, this is not the end of a trend. This is not where you should be going short. This is not where you should be closing off your long positions. This is where you should be applying patience. Let price do what it needs to do. We're looking for a bounce to the upside. When price breaks above this high, that's when we can start looking to add new positions if you're not in the trade, or where you can start looking to add compounds, add more positions, start scaling in. Never ever scale out. Never take profit. Maximize the profit phase. Okay, so that's the euro pound. The pound dollar, similar. You can see we're below the pink lines, so we have a bearish bias. We're below all of these resistance levels. The reason why price is struggling at this point right here is because of the round number 1.2. But the trend is down. Each time price came to a round number, you can see here is 1.7 is where price failed. Then it went to 1.6, broke through, came to 1.5, a little bit of struggle, eventually broke through, came back to retest it. There's your break, there's your retest. There's your bounce down. Came to 1.4, came to 1.3. You can see a little bit of struggle around 1.3, but continued through. We're now at 1.2. So you can see round numbers are significant because they give you levels that price likes to move towards. The way I like to describe this is, imagine if you're jogging. If you're jogging, you're not going to stop at 11.2 kilometers. You're going to stop at either 11 kilometers or 12 kilometers psychologically. That's what you want to be aiming for. If you get past 11.11 kilometers, you then think, well, I might as well get to 12 kilometers. If you get to 12 kilometers and you get past it, you think, well, I might as well get to 13 kilometers. You're not going to stop at 12.4 kilometers. Okay, it's the same thing with price. Price likes to get to those whole numbers. These are psychological levels. So whole numbers make very good target levels. Where people go wrong is that they look for tops and bottoms. They're waiting for price to bounce at these levels. The key here really is to wait and let price break through, apply patience. So if we go to the weekly, we can see that the trend is very much down. Look, there is that struggle around 1.3. Price is now at 1.2. That's the weekly chart. Below the weekly 200, below the weekly 50. Go to the daily. Below the daily 200, below the daily 50. Look at this trend to the downside. There's your 1.2 level. Now, if you just open a chart, look at this move today, guys. You can see the long-term trend is bearish. This is an insignificant move to the upside. So these are buyers coming in, trying to push the market up, or people taking profit in fear of losing money. Okay, but it's insignificant. It's where we apply patience. We want to see the market continue. So we want to see these bears that are coming in and pushing this bar back down. We want to see the bears come in, push price towards 1.2. We want it to clear 1.2, and we want to see price break and close below this pivot. That is when I will be looking to add further compound positions. I've already got positions running. I'm already short on this, very good profit. I'm now looking to add further positions. If we go back to the monthly chart, if I just compress this, you can see that the low of 1985 is around the figure 1. So where price is towards the figure 1, that's over 2,000, that's around, 2,000 pips. So we could potentially see another 2,000 pips worth of movement in the coming weeks. So with short positions running, another 2,000 pips plus the compounding, 2,000 pips can be grown to over 4, 5, 6,000 pips. This is the beauty. A 2,000 pip move in the market or a 3,000 pip move in the market through holding and compounding, you can grow to over 10,000 pips. In terms of percentages, this can be well over 20%. So if you have 2, 3, 4 of these trends every year, that is how you're going to make money, because a single trend can make you 20%. Okay, this is the smart way of doing it, safe and smart. Oh, brilliant. Oh, really fantastic. Maurizio, I was very unaware of that. So that's fantastic. Hello, guys. Apparently, there's 50 people tuned in. So hello to you all. Thank you all very much. I've never been told how many people tune into my webinar, and there's usually very little interaction on the chat box, which gets me a little bit sort of nervous. So if you do have any questions, guys, please put them in the chat box, and I will definitely answer them at some point in the presentation. And I hope everything that I'm saying here makes sense, and I'm not going too fast, or the information is not going past you. Okay, so that's the pound dollar, guys. So just to go back to the daily chart, I'm already short on the pound dollar. I've been short on the pound dollar since 1.4. Okay, and so I've got short positions which have been running around 2,000 pips. So that 2,000 pips is now much greater than 2,000 pips. If it breaks and closes below this pivot support, I'm going to start adding further short positions. Okay, let's go to the pound Aussie dollar. So the pound Aussie dollar is another currency that I'm short on. If we look at the monthly, we can see that the pound Aussie dollar has been weakening. Let me just bring up my crosshairs. Makes it a little bit easier, right? So if I bring up the crosshairs, you can see that the pound dollar reached a high of around, again, round number 2.20. Plus we've got this level here, which was acting as a level of resistance. Remember, technical analysis, guys, support becomes resistance, resistance becomes support. So this green level was a support level. When price came below it, support becomes resistance. So we can see that price came back to retest this level, failed. We had indecision, round number 2.2, and since then price has weakened. Now it's at the round number 1.6, and that's why it's struggling a little bit. And we expect this. Round numbers act as levels where price will struggle, but this doesn't mean the end of the trend. This is where we have to apply patience and wait for price to pass through. If it does bounce, that's where my trailing stop losses come in. So I have a trailing stop loss that's protecting my profits. Okay, so we can see that if it clears this level, then we could see price move towards 1.5 and then 1.4, and we've got these support levels here going back to 2012, 2013, these support levels. If we go to the weekly, we can see that price is trading below the weekly 200, below the weekly 50. So we've got a bearish bias. Excuse me. If we go to the daily chart, below the daily 200, below the daily 50. So we got a bearish bias. Excuse me, on the daily chart as well. Again, if I just open up the chart, there is your flash crash that we had on Thursday last week. But since then, price has just continued to weaken. Again, we've had a bit of bullish action so far today, but this is insignificant in terms of what has happened overall. Again, let me just bring up my crosshairs. Okay, so really price has been weakening since September, handing out good profits. Okay, I believe I've got two short positions running on the pound Aussie dollar, and these two short positions now are in very good profit. What I'm now waiting for is price to break and close below this pivot support, and that is when I will start looking to add further positions. So again, allowing price to dictate, and by letting my positions run, I'm doing very, very little. This is not what I want. What I want people to get away from is thinking that we need to work hard for our money. We work hard day to day. We go to work, we have jobs, we work hours, we have a salary coming through. That's how we're programmed to work. And so people then take that logic to the market, and they want to try and extract money like a 9 to 5 on an hourly rate or a weekly rate or a monthly rate. So people tend to have an idea. I want to make 10% a month. I want to make 1,000 pips a month, 20 pips a day. It's not how trading is done. Trading requires a certain skill set that has to be developed. That skill set is unique to trading. You guys out there, you may be good at what you do as a job. You may be successful business people. You may be good accountants. You may be good personal trainers, whatever you may be. But you've learned to develop a set of skills that are unique to your industry. The mistake that people try and do is bring those skills to trading, thinking that they've already developed their skills in the industry that you're in. It's not how it works, guys. I come from a background of software engineering. I hated it. I then became an English teacher, which I loved, but there's no money. And I then became a photographer, which I loved, but again worked very long hours. So for me to learn to be a trader, I had to learn to be a trader. And I learned to be a trader by finding a mentor, someone who could teach me and give me the skills. So you have to learn to develop the skills that are unique to trading. Excuse me, I'm just going to grab some water. Bear with me 1 second. Sorry, guys. So don't allow your ego, if you like, in a way to think that you already have the skills. You may have the ability, you may have the capability to learn. You may have the ability to pick up concept very quickly. You may have the ability to pick up concepts slowly. It doesn't matter. The point is you have to learn the set of skills that are unique to trading. And most people out there will tell you otherwise. They'll tell you that this is very simple and that you can just make 20 pips a day and that's the way forward. It's up to you guys to actually look through all of that and apply the correct philosophy. This is not what most people think it is. This is empowerment. This is not just about making money, guys. This is about empowering you so that you can have control over your time and over your money. If you're glued to the screen making 20 pips a day, you're not empowered. You think you're empowered, but you're not. You're a slave to your computer for 20 pips a day. But if you can put your risk to work, your 2% risk to work, and that 2% over days and weeks and months grows to 10, 15, 20%, that's empowerment, because you've put your money to work and you're simply managing your positions in minutes a day. Screen time should be no more than 10 to 20 minutes a day. That includes entering new trades, managing your stops on current positions, looking for opportunities that may have arisen. That should all take you no more than 10 to 20 minutes a day once you understand what you're doing. Okay, so don't fall into the trap of thinking sitting in front of your computer making 20 pips a day is empowerment because you're not going to work and you don't have a boss to answer to. Okay, it's not what trading is about. All right, so the pound Aussie dollar, guys, a break and a close below this pivot support is when I will start looking to add further short positions. Okay, let's have a look at the pound Canadian dollar. Now, I'm not in the pound Canadian dollar. Why? Because I'm short on the pound dollar, I'm short on the pound Aussie dollar, and I'm short on the pound yen. I don't want to overexpose my portfolio to pound currency. Yes, they could all be moving in the same direction and they could all be handing out profit. But at the same time, at any moment they reverse, all of those positions are going to reverse against me. So I don't trade. I don't want to go crazy. I don't want to overexpose myself on pound currencies. I look at all the pound currencies. I look at all the currencies. You've seen my watch list. Okay, I've got an extensive watch list here. I've got everything. What I then do is narrow my portfolio down to the group of currencies that are currently trending. So at the moment, all the pound currencies are trending. Some of the yen currencies look interesting as well, but all the other currencies are trading inside those pink lines that I mentioned. So if we go, for example, if we look at the New Zealand dollar, US dollar, you can see it's inside the pink lines. I'm not interested in currencies that are inside the pink lines. If I look at the Aussie dollar, Swiss franc, it's inside the pink lines. I'm not interested. If we look at the Aussie dollar, US dollar, it's inside the pink lines. So by knowing which currencies are inside the pink lines, I can dismiss. And I can then go and narrow down to the currencies that are outside the pink lines. So we've looked at the pound Aussie, we've looked at the pound dollar, we've looked at the euro pound, we're now looking at the pound Canadian dollar. We can see the pound Canadian dollar is trading below the pink lines. It has a bearish bias to it, but there's way too much support level. Support here, 1.6, support here. Too many support levels in the way. If we compare it to the pound dollar, we can see that there's far less support in the way, and there's a lot more space for this to move without a potential bounce to the upside. So always look for the path of least resistance. This is key to trading. Part and parcel of trading is knowing how to manage a portfolio. Don't simply trade something like the euro dollar just because you feel like it and you're attached to it. There shouldn't be attachments. your attachment to anything should only be for as long as it's in trend, and only for as long as it's paying you and giving you profit. As soon as it stops paying you, you want to drop it and move on to something that is paying you. You also want to be aware of stocks. Okay, so if we look at a stock that I am currently long on, Nvidia. Nvidia is a stock that I'm currently long on, and it's the same principle. You can see it's trading outside of the pink lines. When it broke above this resistance level, which is around $40, I started opening long positions, and you can see now that this is valued at around $70. So this has almost doubled in 1, 2, 3, 4, 5, 6 months. So when someone is fixated on small day trading moves on the euro dollar, I'm effortlessly making profit on Nvidia, effortlessly, guys. And I mean, in 6 months, I probably spent around 5 to 10 minutes on this whole process of managing trades, looking for positions, entering, compounding, transferring the information to my broker account. It's taken me no more than 5 to 10 minutes in 6 months. Okay, another stock that I have currently opened a position on, and I've only just started, is NUS. So this is something that you should be looking at. So NUS, I've got one position running on. You can see that the trend is up. It's just broken out of these pink lines. Now look at where it could go to. Look at where the highest point is, $140. So from $70 approximately to $140, that's double. A UK stock I am long on is Boohoo. I'm not sure if you guys are aware of Boohoo. Excuse me. Sorry. So I trade UK stocks. I trade US stocks. Guys, Boohoo. Look at that. Trading above the pink lines. As soon as it broke above the high and around 60, this is when we started going long. And this is now valued at 120. So this has doubled in the space of 1, 2, 3, 4 months. So if you compare this to the euro dollar, which is what everyone seems to be doing, every Tom, Dick, and Harry seems to be obsessed with the euro dollar. Look at the euro dollar. Compare that to Boohoo, which I just showed you. Compare it to Nvidia, which I've just shown you. Compare it to the pound dollar, which I've just shown you. Guys, put it this way. The euro dollar is the most heavily traded currency in the world. We know that. Yet most people lose money. So what does that tell you about trading the euro dollar? Don't be obsessed with it. Okay, I know people are obsessed with gold. People are obsessed with gold. Here is the monthly chart of gold. Now, I traded gold for many years in the bull run. So I started trading around 2007, around this level here. So you can see how gold returned me a lot of profit in that bull run. Since then, gold has been very, very difficult to trade. Now, this is the thing about commodities. What people don't, a chart is a chart. In this presentation, in this webinar, we've looked at currencies, we've looked at stocks, we've looked at commodities. The application of what I'm telling you is transferable across all the markets. So you can see that this is the monthly chart of gold. I'm looking at the pink lines, which represent the high and the low of the previous calendar year. What I'm looking for is price to be either trading above, so it has a bullish bias, or below, in which case it has a bearish bias. We're also looking at the round numbers, 1400, 1500, 1600, 1700. So what I'm looking for is price to break above 1500, and that's when I'm looking to go long. If it breaks 1000, then I'll be looking to go short. But you can see very clearly that at the moment, it's just going sideways. It's not doing anything. So you want to be standing aside from gold. Don't get caught up in the fact that it's gold. It's a shiny metal. It's a safe haven. You hear all of these terms. Don't get caught up in that. Look at the chart and let the chart tell you what to do. Now, one thing to note about commodities, guys, is that they trend for long periods of time and they consolidate for long periods of time. This is a natural feature to commodities. The bigger the consolidation, the bigger the breakout. So allow the breakout to happen and then go in that direction. Okay, but remember, a chart is a chart. Let the market dictate to you what to do. Right, the pound Japanese yen. Now, I'm already short on this. I was short on this from when price broke the pink lines to around 150, so around 2,500 pips. I was short on this, made very good profit, but then I closed my positions when the day before Brexit. Now, of course, in hindsight, I should have held my position. But if we had voted to stay in the EU, then the pound would most probably have rallied. But because we voted out, the pound dropped and it's continued to drop. But at the time, it was a complete gamble for me to whether to stay in or to stay out. So for me, the best thing to do is simply close my positions, take my profit, and allow Brexit to happen, and then go in the direction of the trend. You can see that price is below the 50, below the 200. So we have our bearish bias. Below the daily 200, below the 50, and we have a bearish bias. Again, so you can see that I was short from around just below 180. So I was short from this level here, and I exited around this level here. So you can see the key to trading is holding. And a lot of people panic during these sort of pullback periods. But from 180 to 150, that's a move of 3,000 pips. That's good, significant growth, and I strategically compounded as the trend developed. I'm now short on the pound yen again, and when price breaks and closes below this level, I'll be looking to add further positions. So this is where I apply patience and let the market dictate to me what to do. Okay, let's have a look at the pound New Zealand dollar. Pound New Zealand dollar. Okay, again, very interesting currency. If we have a look, this is now creating all-time lows. What do a lot of people tend to do at all-time lows? When price gets to an all-time low, a lot of people are looking for the bounce because they're thinking the price cannot break an all-time low. If price goes to an all-time high, they're looking for a bounce to the downside. People are always looking to trade tops and bottoms. It's a very difficult way of trading. It's an inconsistent way of trading. The smarter thing to do is to allow a trend to establish itself and then go in that direction of the trend. When price gets to a support level, wait for price to break through. So if I just expand the chart, this is last month. And you can see that it struggled in, what are we in? We're in October, right? So this is July, August, September. So for 3 months, price struggled to break through this all-time low. And then so far this month, we've had the breakthrough. Okay, so we always want to go in the direction of the trend. Now, this doesn't mean to say that it's guaranteed to continue. It could be a fake out, but we can see that the trend is down. The only way we can be confident that this is going to continue is if price breaks and closes below this pivot support. Okay, so this is where we apply patience. We don't want to be going long. We don't want to be going short. I'm not in this. I don't have any positions running. In fact, would I trade this? I don't know, because I'm already short on the pound Aussie dollar. The pound Aussie and the pound New Zealand dollar, they're correlated. So I don't want to be trading correlated pairs. I choose the best looking one. I'm already short on the pound Aussie dollar. But if you're looking to trade the pound New Zealand dollar, the earliest would be a break and a close of this pivot support. Okay, and this is where patience comes in. Okay, I think that's everything that I wanted to cover. So we've looked at all the pound currencies because the pound currencies are where my attention is for now, given the weakness taking place on the pound. Let's just have a quick look at the dollar yen. The dollar yen, again, we looked at this on my last seminar webinar with FX Street, and we can see that price is struggling at 100. Significant level of support. And you can see now for several months that this has just been going sideways. So we've had weakness from around 124, which is the high of 2007. You can see that price failed. We're below the pink line, so we have a bearish bias. But until it clears 100, we don't want to be taking short positions, or we don't want to be taking long positions trying to predict the bounce because we're going against the major trend. This is where we stand aside. We want to see price break and close below this support. This will clear 100, and then we can look for weakness towards 80, and then the low of 2012. If we go to the weekly, we can see that we're below the 50, we're below the 200. Daily, we're below the 200, but we're above the 50. And if you have a look, it's just going sideways. Okay, so this is just going sideways. This is not a very good looking chart and not one that you want to be trading. Okay, guys, so that's everything that I wanted to cover. Okay, so Damien, 20 minutes a day, but the key phrase is when you understand what you're doing. Yeah, sure, Damien. I'm not, you know, you made a very good point. Of course, there is the learning phase, there's the education phase, but that tends to be dismissed a lot. And if people are going through an education phase, they're normally doing the wrong things and they're normally going to the wrong sources. Sitting on the internet looking at free YouTube videos is not going to get you the consistency that you want. Joining free forums online where everyone is day trading and scalping, where one person is long on the euro dollar, another person is short on the euro dollar, is not going to give you the consistency. Paying £50 a month or $50 a month for a signal service where you have no clue how those signals are being created is not going to give you the consistency. So yes, sure, there has to be an education phase, there has to be an understanding phase, just like anything else that cannot be dismissed. But you guys must start learning to focus on the right things. And yeah, you got to study charts, you got to understand support and resistance, you got to understand how to use moving averages, you got to understand how to understand your market environment, you got to be able to understand how to identify where the money is. You then have to be able to understand what strategy to use. Am I using a breakout strategy? Am I using a pullback strategy? How to calculate your stop losses. This is really important. Stop losses tend to get dismissed. If you think about it, the average true range of the euro dollar is 90 pips a day, let's say. But the average true range of the pound Japanese yen is 200 pips a day. So if you're using a 100 pip stop loss on the euro dollar, you may survive a trade. You may survive a pullback. But if you are trading the pound Japanese yen and you have a stop loss of 100 pips, you may get stopped out in a day. So you've got to think of the unique characteristics of each instrument and then calculate your stop losses accordingly. This all takes time. This all takes understanding. It's not difficult. It's actually very, very simple. People complicate it because the simplest things to understand are the ones that baffle us the most. If something is so simple and it works perfectly, the natural instinct or the natural reaction as a human is to complicate it. So we start throwing on Fibonacci's, we start throwing in MACDs and stochastics, we start throwing in 3, 4, 5 moving averages when 1 or 2 are more than enough. We want to complicate things and make things more difficult than they are. Okay, guys, that is me done for today. It's almost 1:45. So as already mentioned, guys, if you want to take things further, please check out the following website. I'm just going to put some information in the chat box, okay? If you want to email me, I've actually got an ebook that I want to share with you all. And this ebook will cover everything that I have mentioned today in a lot of detail. Candlesticks, chart patterns, support and resistance. It will cut through all of the clutter that is very much apparent on the internet. Let me see if I can just quickly bring that up for you guys. Okay, so if you guys can see this, okay, so this is an ebook that I will be sharing out to you all. So if you contact me, this is written by us. Okay, so this is not written by anyone else. This is written by us. It's written by Anne Chapman, the amazing lady that taught me to trade. It's called The Almost Complete Guide to Trading. And you can see that it covers many different aspects that people want to understand, from the trading bias all the way down to a trading plan. Okay, it even covers forex, stocks, commodities, trade management. There's just a lot of information that goes into this. And you can see that it's comprehensive and it's in-depth. Charts, examples, clearly explained, pivot points, etc., etc., etc. You will not find any other book or website or anything else out there with the information that is contained within this ebook. It's groundbreaking, guys. It's cutting edge. Okay, so please send me over your email address and I will get this over to you. Question from YouTube by Noel Collins. So here, any perspective on crude oil? Yes, stand aside. Okay, simple. Stand aside. Crude oil is, until it breaks $50, you don't want to be trading crude oil. I shorted crude oil from $90 to $40 in the last round of trend. and I made significant profit. Since then, I've been standing aside. This goes back to what I was saying earlier. Do not get caught up in oil, gold, because everyone's talking about it. Let the market dictate to you what to do. Okay, Damien, if you can email me, it'll be easier than me copying and pasting down, um, copy and pasting um, emails. Okay, because I'm going to get a ton of emails after this, which I usually do. So please use my email. I'll put it here, zaheer@tdtpro.com, and I'll happily get back to you, guys. Please add me on Facebook if you're on there. If you want to contact me through Facebook, you can do. We also have our own Facebook page. Excuse me. I'm just going to put this all in the chat box. Okay. So I've got my Facebook page. I'm on LinkedIn. So just search for my name. Please add me on LinkedIn. And we do have a Twitter account as well. The Facebook page, if we go back to it, you can see we have videos that go up, charts, everything that we're talking about. A lot of information on this particular particular page. Okay. So if we could start interacting beyond this webinar, then that would be fantastic. Okay, I think that is everything. Damien, brilliant. Thank you very much. Okay, brilliant, guys. Thank you all very much. Administrator, thank you for everything today. People out there on YouTube who are listening in and I cannot converse with directly, thank you very much for your time. And Adinda, thank you very much. And I will see you guys all hopefully next week on the next webinar. Thank you all. Take care. Bye-bye.